Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's 12:30 on October 2nd, and we're joined by Joe Vaclavik of the Standard Grain. Joe joins us often to talk about the ag market, and we also play his morning call where he goes over the overnight recap. He's got a lot of great information, a lot of great insight into the ag market. Joe, how are you today?
Oh, doing good. Grain markets have been up a little bit more exciting here this week.
Yeah, well, I saw, we came into the week and we had a deal with Canada, and yesterday was a very strong rally in corn and soybeans. Today it's relatively quiet. But what was the reason for the move yesterday? Was it all Canada?
I don't think so. I think there were a number of factors. First off, you got to remember we had a quarterly stocks report from USDA this past Friday, and the markets were down hard on that report. It was a bearish report. The quarterly grain stocks as of September 1st were quite a bit larger than what we had expected. So Monday we came in, overnight we were kind of quiet. And then right at that 8:30 Central Time open in the morning on Monday morning, we caught a bid in the corn market, the soybean market. Um, and this was hours after the NAFTA deal or the trade deal with Canada was announced. So I'm not sure that necessarily was everything. I think that had something to do with it. I also think that you've got a new month, you got a new quarter, you've got funds that had been short the corn and soybean markets in particular. Maybe we saw some short covering or just some money kind of changing hands here. I think anybody who trades these grain markets are well aware that October, from a historical standpoint, is about the most friendly month in a calendar year for the corn market and for the soybean market. We tend to post harvest lows or harvest bottoms right around October 1st and then rally through the first week in November. So you got friendly seasonal tendencies. You got the trade deal. You got a report that just, I guess, wasn't bearish enough to really keep the bear market going here. The other thing on the fundamental side would be this rain that we've seen across the Corn Belt. A lot of Iowa, a lot of Missouri, a lot of the southern plains have been very wet and are going to continue to be very wet over the next couple of weeks. And we're still ahead of schedule in terms of harvest pace, but I think that's something that probably changes here over the next couple of weeks. So there is some concern regarding the weather right now.
Yeah. When's the next big release?
Your next crop report is a week from Thursday, the 11th. And in that report, USDA will again update their production numbers for this 2018 year. Now, I would venture to say that a great deal of the production that we've got here is priced into the market. We know we've got big crops. If they were to raise the production estimates slightly, I don't think that would necessarily be a big surprise at this point. So it's going to take something really bearish for us to go down and make new lows in these markets. I would venture to say that the lows that we saw there in September in the corn market and the bean market, those may have been lows that may hold for quite a while.
Hmm. Yeah, well, we've had some supportive price action over the past 10 days, and both have the chart for everybody to see of both corn and soy. I know you've been pretty supportive of soy over the past few weeks, thinking that that might be the low. And a few people we speak to, yourself and Angie also, have been similar for corn, thinking that pretty supportive levels there as well. What's the big spec positions right now in agriculture?
The managed money, large money managers are fairly heavily short the corn market. They're short the soybean market to a lesser extent, and it's kind of a mixed bag in the wheat market. They're long the Kansas City wheat. It's actually a pretty significant long position in the Kansas City wheat, and they're short just a small amount of Chicago wheat. So nothing extreme there. I always tend to look for extremes
Right.
when I'm looking at fund positioning. When they've got a modest position on either side, it doesn't really do me a whole lot of good. When they've got an extreme position in a market, you can when you go through some of these programs and through the CFTC reports, you kind of can get a feel for what's an extreme position. Funds were approaching an extreme short position in the corn market there down toward those lows. They were getting close. They never really got there in the beans. But that's something that I monitor. I think just about every trader who trades commodities watches those CFTC reports and the fund positioning. But we're not at a point right now where there's a big extreme, either long or short position in any of these markets.
Yeah, yeah, and especially now we had such a volatile Q2, Q3, and the past 4 or 5 weeks have really been a bit quieter, tighter trading ranges, less activity. So I think that's also part of the spec activity. People have lost a little bit of interest at these levels.
Well, commodity markets in general are just cheap right now. I mean, if you look at like some of these commodity indices versus say the S&P, I mean, there's like a record wide spread there.
Yeah, we've seen some
if you were to
people.
ever if we were to ever see a sell-off in the stock market, like a real significant extended run into bear market territory, not saying recession necessarily, but just an extended setback, or we get into bear market territory for a year or for 2 years, I think that would be something that would be supportive to commodities overall. The two just seem to have this kind of inverse relationship.
Yeah, well, on that last comment, I know a lot of people like Jeff Gunlock and a lot of other people have looked at that chart that you were referring to, and I don't have it up to show everybody, but basically over a 50-year period, even the divergence of where we are, commodities versus equities, has them long-term bullish. That said, Gunlock was talking about that a full year ago, 6 months ago, and that trade has only continued to widen dramatically. Where we have right now, the S&P is up 10%, Nasdaq's up 15% ish, both ballpark, and the commodity markets ex crude is down for the year. So
Uh,
it's
So being friendly to commodity markets from a long-term standpoint and trading the commodity markets from the long side from a long-term standpoint are two very different things. The fact that we have a massive, massive amount of carry in the corn market, the soybean market, and the wheat market makes it extremely difficult to stay long the market. They essentially punish you every month for rolling your position out another month or two. It really makes it very, very difficult. It's much easier to be short the markets. You're able to roll your position every month and actually pick up money on that roll. And that's probably one of the reasons why we've seen the funds continue to hold shorts in the corn market and in the soybean market. It's a lot easier to be short the markets long term when you've got carry. And what I mean by carry is that our front months are priced well below our deferred month contracts. That makes it very, very difficult to stay long over the long haul, and it makes it much easier to maintain a short position.
so if I was bullish long term, like I'm talking 5, 10 years out, the ag sector, corn, wheat, soy, what's the best way to position myself then?
That is a very interesting question, and different people would probably tell you different things. I mean, there's not a whole lot of liquidity in the futures markets once you go out past, say 12, 15 months. So the futures are probably not your best bet. I mean, yeah, you could go out and buy some, December 2020 corn, but again, you go out to December 2020. I don't even know if they're trading a whole lot of that yet. So D's 20 traded $4.13 today. That's you're talking what, 40 or 50 cents above spot month futures. So you're giving up a tremendous edge just to be involved in the market to do that. And it might be a position that works out for you over the long term, but it might be a position where they just bleed carry out of the market, or bleed you down, and these spot month futures eventually kind of come down to where the last expiring contract left off, and you're kind of just left holding the bag. So it's really tricky. I mean, from a long-term perspective, if you were to say I'm friendly agriculture for 10 years, I mean, there would probably be people that would tell you, oh, you could buy, ag related stocks, or you could buy seed companies or manufacturers, or you could buy equipment manufacturers. You could buy John Deere or Caterpillar, or one of those. There's a lot of different ways to play it, and you don't know for sure which one's going to pan out.
Yeah, well, that's exactly it. Is it individual names? Is it through the companies? Is it through futures? Is it through some different ETFs? Because the problem with the ETFs also, it sounds like there are large fees, and those indexes are based off of the front month contract on many
Right.
of
The
them.
ETFs make it very difficult to stay long because they're basically holding a position in front month futures. And just like you would be if you bought spot month corn, you're going to eat that roll every single month. And you're not going to see it necessarily reflected in the index as clearly as you would if you were to buy futures, but it will negatively affect the value of that index.
Right, right. So what else is on the radar? You said next Thursday we have the report. I guess we're always on China alert for more information about that, because that's a big mover in the
That's the
ag
biggest
land.
thing. It's the biggest thing out there right now. It's the giant wild card that's it's just a dark cloud hanging over these markets. And if we ever came to some sort of resolution with China in regard to trade, the landscape of these markets would be altered drastically overnight. But for now, it doesn't look like we have any progress on that front. Trump just continues kind of a hardline stance here. China doesn't seem to want to play along. So, I mean, for now, we got nothing to work with. But that's the biggest deal. It's by far the biggest wild card we have. For the most part, we know what U.S. production is going to be. We've got a pretty good feel for it at this point. South America is starting a growing season now. They're off to a good start. A lot of people are just working with the idea that they're going to have trend crops down there. There's no reason to think otherwise at this point. But that China thing is what could really alter the landscape of these markets.
Yeah, absolutely. Anything that you guys, I know you speak to a lot of different traders and a lot of different farmers as well, but is there anything off the radar people are kind of looking at opportunities for, piquing their interest?
Oh, off the radar. I mean, everyone's doing something different. I mean, I talk to people who are day traders. I talk to people who are position traders. I talk to people who are farmers, who are feedlots. One thing that the general public is probably not aware of is that the basis levels for these cash crops are some of the worst we've ever seen. And when I say that, I mean that the basis is the difference between the cash price and the futures price. So, November soybean futures for this fall delivery, you're trading at $8.62 a bushel right now. There is nowhere in the country that you can get $8.62 cash money for your beans. The best basis levels are maybe 40 or 50 cents under that. So maybe the best cash bid, and say maybe somewhere in Illinois today is like $8.10 or $8.15. There are places in the country, North Dakota would be probably the best example, where the basis is like $2. So cash beans might be south of $7, where the futures are $8.62. Basis is a function of local supply and demand. You got to remember that these border trade contracts are deliverable only at a given number of points. Most of them are along the Illinois River. So when you're out, far away from that delivery point, you're in North Dakota, and most of your beans usually go to the PNW and eventually make their way to China. That market's not there right now. You've got yourself a major problem. So not only are beans cheap, they're actually a whole lot cheaper than the futures price would suggest.
Hmm. All right. Well, thanks a lot for the information. Thanks a lot for the quick update on the ags. Thanks. Let us know when something happens. It looks like they are going to start to move in one direction or the other. We've been kind of, hovering around these levels for 5-6 weeks. So I'm looking for some sort of volatility here. But thanks for the update, Joe.
Yep. We'll talk to you next time.
All right. That's Joe Vaclavik of Standard Grain.